In today's volatile business environment, companies must be prepared for unexpected disruptions. Financial strategies during crises require a delicate balance between maintaining operations and preserving capital. Successful organizations implement multi-layered approaches, including emergency funding reserves, flexible credit lines, and rapid cost reduction protocols. When crisis strikes, immediate access to liquidity becomes paramount. Leading firms maintain cash reserves equivalent to 3 to 6 months of operating expenses. They also establish pre-arranged credit facilities that can be quickly activated. These financial buffers provide crucial breathing room for executing broader response strategies. Cost management during crises follows a strategic hierarchy. First, companies target discretionary spending and non-essential operations. Next, they evaluate workforce adjustments while being mindful of maintaining core capabilities. Finally, they may pursue structural changes like divesting non-core assets or renegotiating major contracts. Business continuity planning. Business continuity planning represents the backbone of organizational resilience. It encompasses detailed protocols for maintaining critical functions during disruptions. Modern continuity plans integrate operational, technological, and financial components into a cohesive framework. The planning process begins with business impact analysis, identifying essential operations and their dependencies. Organizations must determine minimum resource requirements for these core functions. This includes staffing levels, technology infrastructure, and financial thresholds. Regular testing and updates are crucial elements of effective continuity planning. Companies conduct simulations to validate their plans and identify gaps. These exercises often reveal unexpected vulnerabilities, particularly in supply chains and technology systems. Case studies of financial resilience. The 2008 financial crisis provides valuable lessons in organizational resilience.
2008 was a tumultuous year for the economy.
I think this is the most significant financial crisis in the post-war period.
Companies that survived and thrived shared common characteristics: strong cash positions, diversified revenue streams, and agile decision-making processes. Consider the example of a global manufacturing firm that maintained operations during severe market contraction. Their success stemmed from previously established contingency funds and rapid implementation of cost controls. Meanwhile, they protected strategic investments in research and development, positioning themselves for the eventual recovery. Another instructive case involves a retail chain's response to digital disruption. Rather than merely cutting costs, they redirected resources toward e-commerce capabilities. This strategic pivot, supported by careful financial planning, transformed a potential crisis into an opportunity for growth. The role of insurance in risk management. Insurance serves as a critical tool in financial risk management. Beyond traditional property and casualty coverage, organizations increasingly utilize sophisticated insurance products to protect against business interruption, cyber threats, and reputation damage. Modern insurance strategies require careful analysis of cost versus coverage. Companies must balance premium expenses against potential risks. This often leads to hybrid approaches, combining insurance with self-funded risk retention. The evolution of parametric insurance has introduced new possibilities for risk transfer. These products provide rapid payouts based on predefined triggers, eliminating lengthy claims processes. This innovation proves particularly valuable during crisis situations requiring immediate access to funds. Furthermore, captive insurance companies have emerged as a strategic option for large corporations. These wholly owned subsidiaries provide insurance coverage to their parent companies, offering greater control over risk management and potential tax advantages. Organizations can customize their coverage while maintaining direct oversight of claims and risk assessment processes. The rise of microinsurance and usage-based policies has also transformed the risk management landscape. These flexible solutions allow companies to adjust coverage based on actual exposure and operational patterns, potentially reducing costs while maintaining adequate protection. Additionally, the integration of IoT devices and real-time monitoring systems has enabled insurers to offer more precise risk assessment and dynamic pricing models, fundamentally changing how businesses approach insurance strategy. Emerging risks and preparing for the unknown. Today's business environment presents unprecedented challenges. Climate change, cyber threats, and geopolitical instability create complex risk landscapes. Organizations must develop adaptive strategies that anticipate multiple scenarios. Emerging risks require new approaches to financial planning. Companies are building more flexible buffer systems that can respond to various threat types. This includes maintaining multiple banking relationships, diversifying supply chains, and developing alternative revenue streams. Technology plays an increasingly important role in risk identification and response. Advanced analytics help organizations detect potential threats earlier. Artificial intelligence supports scenario planning by processing vast amounts of data to identify patterns and potential outcomes. The rise of environmental, social, and governance (ESG) risks adds another dimension to crisis preparation. Companies must consider how sustainability issues might trigger future crises. This includes physical risks from climate change and transition risks from evolving regulations. Cryptocurrency and digital assets present both opportunities and challenges in crisis management. While they offer new tools for financial flexibility, they also introduce additional risks requiring specialized management approaches. The importance of stakeholder communication during crises cannot be overstated. Organizations must maintain transparent dialogue with employees, customers, suppliers, and investors. This communication strategy should be integrated into overall crisis management plans. Human capital remains a critical factor in crisis resilience. Companies must invest in training and development to ensure staff can execute continuity plans effectively. This includes regular drills and updates to keep skills current. The future of crisis management will likely involve increased integration of technological solutions with traditional financial strategies. This hybrid approach allows organizations to respond more quickly and effectively to emerging threats while maintaining operational stability. Successful crisis management requires constant evolution. Organizations must regularly review and update their strategies to address new risks while maintaining core protective measures. This dynamic approach ensures continued resilience in an increasingly complex business environment. The interconnected nature of modern business means that crises rarely remain isolated. Companies must consider how disruptions might cascade through their networks of partners and suppliers. This understanding should inform both planning and response strategies. As we move forward, the distinction between crisis management and normal operations continues to blur. Leading organizations are building resilience into their standard operating procedures rather than treating it as a separate function. This integrated approach provides more robust protection against future disruptions.